So before we start, um, I've really been so tied up this month. I think this is one of my busiest months ever. But I still have to be making out time for the classes. Thus, I've just been in between. Like I've been moving from state to state. In fact, like traveling a lot. So just had to like fix the classes, and tomorrow will be and Sunday will be the last class. That's the directional bias class. So if you know there are questions that you have regarding the classes that I've taught, and maybe you have confusions, that all the question sessions will be tomorrow, will be on Sunday. So prepare yourself for that day. Even the questions for this particular class also will be on Sunday. But I'm already seeing people's progress. Even with the two classes, they're able to pick points of interest well. They're able to get the market structure shifts, their double breakout structures, and I'm really happy with what I'm seeing. So yeah, so in this particular class now, this one is on the different types of liquidity that we have in the market and how we take our profits in the markets using those types of liquidity. Now, we trade liquidity-based systems, meaning that we use liquidity to get into the market. We also use liquidity to get out of the market. Because if you notice, we have market structure, the liquidity is included, and before we can pick any entries, we have to make sure we spot our inducement and then be able to wait for the inducement to be swept for our point of interest to trigger. That means that one of the things that fuels this market is liquidity. Market literally targets where there is money. Liquidity means money. Just like someone telling you they are liquid, they have liquid cash means that they have money. So that's what liquidity means. Where there's flow of money in the markets, meaning that is where price is more likely to head to. And then since price is more likely to head there, we now use those things as our take profit levels because they are simply what the different types of liquidity that we have in the market. I'm trying to continue. Can you guys hear me well? All right. So like I said, we trade liquidity based. Whatever fuels the market for us is liquidity. It means that we target where there will be liquidity in the markets, and then we put our take profit levels at those zones. So one thing with liquidity is that market will always target where there's liquidity. And if you are trading against markets heading to a liquidity zone, you'll end up losing because markets would want to go and what head to where there's money. And if you're opposing market going to where there's money, then you are trading at the wrong direction of the market. So in this particular class, I'm going to list all the different types of liquidity that we have in the market and how we can take our profits in the market once we spot those types of liquidity we have. So one of the most common type of liquidity that we have in the market and the one that you can spot literally everywhere, I will take different pairs and then you spot it everywhere. It's very, very common, is trend line liquidity. Now, we already know that there are two types of trends. We have the uptrend, then we have the downtrend. Now, trendline liquidity is the liquidity that is being formed when market is on any of these trends. If price is on an uptrend, there's trendline liquidity being formed. And if price is on a downtrend, there's also trendline liquidity being formed. So, for example, if you have market giving you a series of higher highs, higher low, higher high, higher low, higher high, higher low, higher high, higher low. What this means is simply that there is trendline liquidity being accumulated on the downside of this chart. Now, this is what an uptrend, and then the liquidity that's being made when price on an uptrend is what trendline liquidity. And the trendline liquidity is being accumulated on the downside of the chart here. Same way, if market is on a downtrend, giving you a series of lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. It means that there's trendline liquidity being accumulated on the upside of this chart here. What it means is that eventually, if price should start reversing, it means that there's trendline liquidity being accumulated on the upside of the chart here. So whenever a market is in a particular trend, there's liquidity being accumulated on the opposite side of that trend. So if market's on an uptrend, there's usually liquidity being accumulated on the downside of the chart. And if market's on a downtrend, there's liquidity being accumulated on the upside of the chart. Now, how do you apply and use trendline liquidity? Now, there are two ways we can use trendline liquidity in taking our profits in the market. Now, first of all, wherever there's liquidity in the market, it is already determined that market would eventually go and take out that liquidity. So as we have this uptrend and this is trendline liquidity, eventually we will see expect market to come and sweep this trendline liquidity here, and it means we expect market to sell until it takes out this trendline liquidity, meaning that it will sell until price goes to where the trendline liquidity started from, which will mean for price to sell until it takes out this low of where the trendline liquidity started from. Same way, if market's on a downtrend, we expect market to eventually buy and then clear this trend line liquidity, meaning to go to where this downtrend started from and then sweep the high of it. Then that means that liquidity has been the trend line liquidity has been taken out. So how do you now apply trend line liquidity in the market, and how do you take your profits using trend line liquidity? There are two ways. There are two ways to do that. Now, the first way is by what? Is when market is on an extensive, is on a particular trend for an extensive period of time, then giving you a shift in structure. Then you can apply trend line liquidity to what? Take your profit in that trade. What I mean by that is something like this happening. Let's say you have an uptrend that has been going on for an extensive period of time. I can say days or some hours or something, giving you higher high, higher low, 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 higher high, higher low. So this has been happening for a long period of time, a long uptrend. Then all of a sudden you get something like this. Once this happens, we already confirmed what? Our structure part of our strategy, which means that we confirmed a shift in structure. And then a shift in structure, that is a market structure shift, is used in trading reversals, meaning that whichever pattern or whichever trend that market is on, the market will oppose the direction of the market to the opposite side. So what it means is that the moment you get this structure shift, it means that market is about to change direction to the downside. So what you now have to do is, after that, you now expect price to give you your inducements, then eventually come and sweep your inducement to trigger your point of interest. So you've gotten the first part of your strategy by getting the structure shifts, getting the inducement, and then getting your point of interest. What is now left is where you will keep your take profit level for this trade. Now, what you have to do is, before you take your profit in the market, you have to observe the pattern that price was previously on before your point of interest got triggered or before the shift in structure happened. So if you just take time to observe down here, you can clearly spot what? Market on a previous extensive uptrend. You see higher high, higher lows. So this is what? An uptrend. And like I said, whenever there is whenever market is on a particular trend, there's trend line liquidity being accumulated on the opposite side of the chart. Meaning that since market was on this uptrend, down here is what? Trend line liquidity. What it means is that eventually, the moment that price gave us this reversal concept, meaning that price is about to change direction from the uptrend to now a downtrend, and then market gave us our inducement and then triggered our POI for the sell. Our take profit level will be aimed at what? Where this trend originated from, which will be this low. What it means is that the moment you get this structure shift confirmation, got your inducement, which is your liquidity, and then gotten your point of interest, your take profit level for this trade will be to observe the previous pattern that market was on before the structure shift happened or before your point of interest got triggered. And if you observe the pattern, you can clearly see one type of liquidity that we have. And then that one type of liquidity is what? This trend line liquidity. And wherever there's trend line liquidity, there's money being accumulated on the opposite side of the trend. So since we had the previous uptrend, the money on this chart will be on this downside, meaning that down here is literally filled with liquidity, and market is going towards sell until it takes out the trend line liquidity and take out where the trend originated from. Meaning that if you should take a sell from this other block based on your analysis, no, based on our analysis, our entry will be from this breaker block. So if you take your trade from there, your take profit level for this trade would be to target the trend line liquidity. So you will keep selling the market until it successfully clears this trend line liquidity. Now, this is one way to use trend line liquidity, and this one shows up just few times. The most common way is when market um starts maintaining a particular trend while approaching your point of interest. But this one can also be used. An example of that is this. We had a previous extensive uptrend here. You can see it now. So just had this previous extensive uptrend. Then price came and gave us a structure shift, taking out the low, giving us inducement, and then triggering. This is a 45 minutes breaker and the 3 hours order block here. The moment this happened, what I'll be looking at is where my take profit level would be. And if I observe to see my take profit level, I can actually see that price was previously on an uptrend. And this means that what? There's trend line liquidity being accumulated on the downside of this chart here. Meaning that the moment I take my sell from this trade, from here, my take profit level for this trade will be aimed at the nearest draw on liquidity. We call it the nearest draw on liquidity because it's where market is more likely to go to next. So the moment I should take my sell from here, my take profit level will be aimed at the nearest drawn liquidity. And if you observe the nearest drawn liquidity, you can spot this previous uptrend, which is what? The trend line liquidity. This particular trade was also taken this trade here. This trade was I want to show you guys the trade because I use trend line liquidity for that take profit level. So I want to find that particular trade. I want to find out. So this was that trade here. So this was a 45 minutes breaker block. I spotted this previous uptrend that price was on. Then I got the structure shifts telling me that market is about to reverse directions. Then I got the nearest point of interest, got my inducement. Then for my take profit level, all I did was just to observe the previous pattern that price was on before that structure shift occurred. And once I observed this, I was able to spot this previous clear uptrend. And knowing that wherever there's an uptrend, there's trend line liquidity being accumulated on the downside of the chart, I knew that my take profit level would be aimed at where the trend started from. That was why my take profit level was at the low of where the uptrend originated from. The trade was clean and it hit full take profit level. So that's this particular trade right here. So that's one way you can use trend line liquidity. When market is on a particular trend for an extensive period of time, then gives you a structure shift, inducement, and then you get your point of interest. The moment you get that, you now target where the trend originated from. Another way, this is the same thing here. You can see this clear downtrend, a previous downtrend before price took out this high. So this became a structure shift and then gave us inducement and came to trigger this. This is a 4 hours order block right here. 4 hours order block. And when this happened, the next thing on my mind would be, since market was previously on a downtrend and we already got towards a reversal, meaning that market is about to change direction to the upside, I got my inducement, I got my POI, where would my take profit level be? If I should just observe the previous pattern that market was on before the shorter shift to the upside happened, I can spot a clear downtrend. And since market is about to reverse, what I'll be looking at now is what? The pattern that price was previously on before that reversal came in. And I can see a clear downtrend. Meaning that the moment I take a buy, my take profit level will be aimed at what? Where the trend originated from, which will be up here. This is the trade, full take profit level. So that is one way to take your profit in the market using trendline liquidity. But the most common way to use trendline liquidity to take your profit in the market is when market starts giving you a particular trend during the process of approaching your point of interest. This way is hardly shows up, but it shows up once in a while, like the one that market will be on a particular trend for a long period of time, gives you a structure shift for reversal, then you target where the trend originated from. That's one way, but it's not one of the most common ways. The most common ways to use trendline liquidity is when you already have your point of interest. Then during the process of market coming to approach your point of interest, it now starts moving in a particular trend. For example, let's assume that you had price give you a structure shift, inducement, then pushes up. Now you already know that since you have your inducement, your point of interest will be at the other block here. Then during the process of market what, let's say market gives something like this, then eventually, before coming to approach your point of interest, it now starts something like this: lower high, lower low, 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 lower high, lower low. Now, market was not on a particular extensive trend before. So we just happen to get a structure shift, got our inducement, and we got our point of interest. Now, if you're looking for way to keep your take profit level, this is where you now wait to observe the pattern that market was making before the point of interest you have mapped out approaches. And if you observe the market, you can clearly see that price was on a downtrend, giving us lower highs and lower lows during the process of approaching our other block for the buy. It means that if I should take my buy for this other block, my take profit level will be aimed at where this trend originated from, up here. So this is one of the most common ways to use trendline liquidity. If you pay attention, we have market giving us the double breakout structure, inducement, and then we have our breaker block here as our entry. Now, we had the entry, we had no idea on where to keep our take profit. Market kept making these movements. So we're making this movement, keeping our take profit level will be hard for us. But what the market do, now during that process of coming down to now trigger our point of interest, which is the breaker block, it starts maintaining this downtrend, giving us what? Giving us, come on, giving us lower high, it's giving us lower low, giving us lower high, it's giving us lower low, it's giving us lower high, it's giving us lower low, it's giving us lower high, it's giving us lower low. So this is what? A clear downtrend. So because it's a clear downtrend, it means that this is what? Trend line liquidity. And when market is making trend line liquidity, the liquidity is being accumulated on the opposite side of that trend. So since this is a downtrend, the liquidity will be accumulated on the upside of the chart, meaning that there's money laying on the upside of this chart here. And now that price has approached our point of interest and triggered the point of interest using this trend-like pattern, our take profit level will be aimed at where the trend originated from. Meaning that if you take our buy from this breaker block, our take profit level will be aimed at where the trend line started from, which will be up here, the high of this trend line right here. This is the most common way to use trend line liquidity. When you've already gotten your structure shift or your double break of structure, already gotten your inducement, and then marked out your point of interest. Then during the process of market now coming to trigger your point of interest, you now observe to see if you can find the trend line liquidity. It may come while market is on this way to approach your point of interest. It may come later, it may come before that, or all those things, but you will make sure you can spot at least one type of liquidity pattern on the market, and that will help you with where your take profit level for that trade would be. So another example of that is here. We already spotted our sort of shifts, inducement, then point of interest, this other block. Now, price already pushed up to this level. So what the take profit level for the trade will be, we are very skeptical. We don't know yet because price was at this level. Now, the moment price started approaching our buy POI, which is the 1 hour order block, before it approached it, it started giving us a downtrend, which is lower high and then lower low, lower high and then lower low, lower high, lower low, lower high, lower low. This is a clear downtrend. Since this is a clear downtrend, it means that there's trendline liquidity being accumulated on the upside of the chart here. So what it means is that Since this is what? A downtrend, and the trend line liquidity for the downtrend will be what? On the upside of the chart. If we should take our buy from this 1 hour order block, our take profit level will be aimed at what? Where the trend originated from before our point of interest got triggered. And if we check where the trend originated from, is this high right here. But that's where our take profit level for the trade would be. This same thing is this trade here. Um, um, hang on. This is the trade here. You see the trade? This was before it triggered. Then I kept my take profit level here. But the moment that price made this pattern and gave me the trend line, I had to adjust my take profit level exactly to where the trend line started from. So this was the when I had the analysis, my TP level, I was still unsure because price had not yet given me a proper pattern. But the moment that price made this what gave me this downtrend pattern before my point of interest approached, what did I do? I had to adjust my take profit level to where the trend line liquidity is. This was the trade before it triggered, when it triggered, and then when it hit final take profit here. I got another entry, but this is when it hit final take profit. So that is the most common way that we use trend line liquidity when market starts giving you that trend like pattern during the process of creating your or during the process of coming to approach your point of interest. You can see it on the sell side here. Shorter shifts, inducement. Our breaker block is the entry. This is the inducement here. Our breaker block is the entry. Now, we had our entry for here, but now for the take profit level for this trade, since there are a lot of candles here, your take profit level will start confusing you. You won't really know where to keep your TP. But what the market do eventually, before price now start coming to approach our breaker block here for the buy, what the market start doing, it started maintaining this uptrend. You can see higher highs, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, until it was approached this zone that we had to sell. Now, we are going to ignore every other candle movement that price did here and focus on the one that price was on before the point of interest got triggered. And this is what? A clear uptrend. Since it's a clear uptrend, it means that the trend line liquidity is being accumulated on the downside of the chart. So if you should take your trade from here, your take profit level will be aimed at where the uptrend line originated from, which is going to be this low. So that was where the take profit level for this trade will be. Now, the mistake that most people make is trying to oppose market sweeping trendline liquidity. If market gives you a liquidity pattern, be it a downtrend or an uptrend, and market is now at the process of sweeping that liquidity zone, do not try to oppose the market direction with any point of interest that is enclosed inside of that liquidity zone. I will make I speak pidgin. I know late to sabi speak pidgin, but if market they are the process of sweeping trendline liquidity, don't try to oppose the market direction with the points of interest that are inside of that liquidity zone. What I mean by that is, let's assume that you have a sell point of interest here. And then before price approached your sell point of interest, it started giving you an uptrend. Higher high, higher low. 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 Then it triggers your point of interest and then starts selling. Now, this is what? An uptrend, which means that there's trendline liquidity being accumulated on the downside of this chart. The mistakes that most people make is them now saying, oh, this is a structure shift or this is a break of structure. Down here is an inducement. So here will be a breaker block. So I'm going to take a buy from here. Now, they're going to what? They're going to blow their accounts. Why would they blow their account? Because they did not sit down to observe the pattern that market was on before trying to enter the trade. Now, price was on an uptrend, good and fine. But if you check, market already triggered a zone where a reversal is supposed to come in. Since that reversal is now in progress, there's no point trying to oppose the market direction until price successfully clears the trend line liquidity here. Any buy that you take from whether this breaker, this OB, this OB, no matter any trade you take with any point of interest that is enclosed inside of this uptrend here, you're going to keep getting stopped out until price successfully clears that trend line liquidity. Just like this, price already hit a zone for reversal that we analyzed here. This breaker block, this is the inducement. Structure shift inducement breaker. We already have the analysis. Now, before price triggered the zone, it started maintaining an uptrend, giving us a clear trend line liquidity that price has to sweep down here. This is what? Trend line liquidity. I give it TL. I will name it TL. Now, simply because there are points of interest that you can find inside this trend line liquidity does not give you the right to start trading from those POIs. Yeah, we can clearly spot an order block here. We can spot another breaker here. In fact, you can also spot a breaker block here. You can even spot another breaker here. All these points of interest are useless. The market may give you a little bit of reaction there, but it's never going to hold for an extensive period of time. Any POI that you have enclosed inside of a liquidity pool while market is at the process of clearing liquidity, do not try and use that point of interest to oppose the market direction. You're going to keep getting stopped out until price successfully clears that trend line liquidity or any other type of liquidity that you have. So this is an example of it where they sell. Any point of interest that you're looking to use for a buy, while market has already triggered this zone for a reversal, and the nearest drawn liquidity is this trend line liquidity. Any point of interest that is inside of this trend line liquidity, don't try and buy with it because market will keep getting you stopped out until it successfully clears this trend line liquidity. So are you guys following me up, please? Let me go again. If you have a point of interest marked out and price triggers the point of interest that you have marked out, you have to observe the pattern that market was making before the point of interest you had mapped out got triggered. If you observe that pattern, you will spot either of the liquidity types. Now, the one I'm talking about now is trendline liquidity. So let's assume you spotted trendline liquidity and you have it marked out as where price is heading to. Even if you don't want to hold your trade for that trendline liquidity to be swept, do not try to oppose the market direction with any point of interest that is inside of that trend line liquidity. Let's assume when I have this, my order block zone marked out, and I want to buy from that level. Simply because let's assume I didn't hold a trade to this level, and let's say I exited here. Just because I exited the market here does not now guarantee that I'm supposed to start selling the market when there is still trend line liquidity here for price to sweep. It means that you don't oppose the market direction with points of interest that are enclosed inside of a liquidity pool. So the only point of interest that you can be using to sell the market later on are ones that are not inside of this trend line liquidity. Will be maybe one that is outside of here. That's when you can use and sell the market. But provided that the point of interest is inside of this trend line liquidity, where market is at the process of clearing the trend line liquidity, don't use that point of interest to oppose the market direction. Same thing here. A breaker block got triggered. Before our point of interest got triggered, there was a downtrend. So we can spot that downtrend as what trend line liquidity, meaning that our take profit level will be at the high, at where the trend line liquidity started from, which will be this high. Now, do not try and use any points of interest that are inside of this trend line liquidity here to now start opposing the market direction. There's a breaker block here, yes, but it doesn't mean that it's going to hold for an extensive period of time. In fact, most of those zones would just cause a retracement in the market so that they can trigger more zones for that liquidity zone to be swept. So if you're selling from this breaker block here, it's not going to hold. Market just use this as a small retracement to trigger this breaker here so that more buys can come into the market. Price will not oppose direction until it successfully clears the liquidity zone. So one of the most common type of liquidity that we have in the market is trend line liquidity. It's everywhere on every pair. It's one of the most common type of liquidity that we have in the market. So you can spot it literally everywhere. Once you have your point of interest marked out and you look at the pattern that price was on before your point of interest got triggered, trust me, you will see trend line liquidity. An example of it is this. This is trend line liquidity here. So if you observe the pattern that price was on before your point of interest gets triggered, it will tell you exactly where you should be expecting market to go to. So you can see what trend line liquidity. And what the price do, the moment it started buying, it bought until market swept that trend line liquidity. See? Trend line liquidity. Now, the moment price started selling, what they do, it sold until the price cleared that what trend line liquidity. So the moment that you've already gotten your POI marked out, all you have to do is what? To now look at the patterns that price was on before the point of interest that you had marked out got triggered. So once you mark out that pattern, you will spot either one or two liquidity type, and then that will help you with where your take profit level would be. So I want to see, there were trades that we took last week. I want to use as an example. So let me see. Okay. I want to see a trade. I want to spot this thing. Cool. Okay. One example. Here. I think it's clear there. Hang on. Okay, here. The trades that I used to give an example. Now, first of all, we had a previous extensive downtrend before market gave us a structure shift, inducement, and then our breaker block here getting triggered. Now, since we already have the POI, what you have to observe is the pattern that market was on before your point of interest got triggered, or before the structure shift occurred. And if you look, you can really spot a previous downtrend. You can see lower highs, you can see lower low. So this is what a clear downtrend. It's not really that clear, but this is a downtrend. Since this is a downtrend, you can take your trade from this zone, this breaker, and your take profit level will be aimed at where the trend originated from, which is this high. And if you don't want to take it that far, if you also observe the pattern that market was on before our point of interest here got triggered is what? Lower high, lower low, lower high, lower low, lower high, lower low. So this is what? A clear downtrend on its own too. So you can still use this as your take profit level, which is if you don't actually want to take it that far, you can do this and then use this zone as your take profit level here. Let's see the nearest draw on liquidity. So whichever pattern that market was on before your point of interest gets triggered will go a long way in telling you where your take profit level would be. And majority of the time, price approaches the point of interest in a trend-like manner. For example, this sell that happened here from these trees at this other block level here. Before price approached the zone, what was it doing? Can see a clear uptrend here. Since the clear uptrend, what does it mean? The moment your point of interest gets triggered, your TP level will be aimed at where the trend originated from, which will be this low. So when the sell was taken from this zone, our take profit level will be aimed at what the trend line liquidity here. Now, while market is at the process of selling, simply because you have maybe like an order block level here or an order block level here, another block level here also, does not mean you should use any of those points of interest to try and buy the market up, because market's already selling. This is what structure shifts. This is an inducement. Then the nearest point of interest is other block. So since market's already selling, the pattern that price used to approach our point of interest is very important, is this uptrend. It means that our take profit level will be aimed at where the trend originated from, which will be down here. Now, provided that market is now at the process of clearing the trend line liquidity, don't try and oppose the market direction by using points of interest that are inside of that trend line liquidity. That's why before market started buying, what did it do? It first of all went to clear that trend line liquidity first, and then used a point of interest that is outside of the trend line liquidity before it started buying up. So that is one way you can take your profit. That's one type of liquidity that we have in the market. That is trend line liquidity. It's one of the most common types of liquidity that we have in the market. It's very, very, very common everywhere. Literally everywhere on every single pair, you will see trend line liquidity. It's one of the most common types of liquidity that you have in the market, and you can use it to take your profit in the market also. Even if it's not that clear, you can still spot a trend line liquidity. This is what an OB level here. Before price bought from this level, you can clearly see a downtrend. Before market bought from this zone, bought until it cleared the trend line liquidity, which is where the downtrend originated from. So whenever price approaches a point of interest, majority of the times it does so in a trend-like manner. In fact, I would prefer for market to approach my point of interest while in a trend-like manner than for it to just impulsively approach the point of interest. If this is a point of interest that I have, a buy level, let's say I have a structure shift, inducement, and then price pushes up, and then I'm expecting price to come buy from this level here. This is level. I would rather appreciate market approaching my point of interest in this manner rather than market approaching my point of interest in this manner. Because with this pattern, I'm very sure, or I will be 90% sure that there is money here in the market that price would eventually go and take out. So I will be more than happy to take this trade rather than me taking the trade that approaches the point of interest using an impulsive move. So this would be correct for me to use rather than this. So whenever price approaches a point of interest in a trend-like manner, it's more convincing to use that POI because it shows like zones in the market where price can actually head to. For example, when we had this trade here, before price approached it, it made this lower high, it made this lower low, lower high, it made this lower low. Even though the trend is not perfect, but you can see a little bit of downtrend pattern there. But so whenever you have a trade and market approaches your trade in a trend-like manner, it's more likely that trade is going, that POI is going to hold. Another one is this GJ. This is another block on GJ. Social shifts, inducements, point of interest here. Before price approaches the point of interest, you can clearly see what this uptrend. So you see higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. So this is what? An uptrend. We already had our POI marked out. Now the process, while market was approaching our point of interest, it was giving us what? This uptrend. So this is what? A trend line liquidity. So simply because we have this trend line liquidity and our point of interest gets triggered, our take profit level will be aimed at what? Where the trend originated from, which will be this low. So the moment you take a sell from this level, the take profit level will be aimed at what? That trend line liquidity here. Now, while market is at the process of clearing that trend line liquidity, do not try and oppose the market direction using points of interest that are enclosed inside of the trend line liquidity. For example, buying with this OB, wrong. Buying with this OB, wrong. Buying with anything that is enclosed inside of this trend line liquidity, wrong. Now, notice something. Market only started what? Buying up after it cleared that trend line liquidity. It now uses another point of interest that is outside of that trend line liquidity to now start buying. So So, um, that is one type. I've been talking about trendline liquidity here for like how long now, but I just want to tell you how important the topic is, how important the trendline liquidity is. Yeah, there was a buy that happened from here. I don't really know the zone it happened from. Is it this? Okay, it's an OB level here, right? OB level. Yeah, structure shifts, inducements, then other block. Now, at this level, our TP is going to confuse us. Our take profit level is going to confuse us. Where will you keep your take profit level? Where will you keep your take profit level? Oh my God, I'm so confused. Oh my God. Then remember, I thought of something. No, he said, observe the pattern that price was on before your point of interest gets triggered. It will tell you where your take profit level will be. And if you observe, ignore every other thing here. The process that the market was now coming to trigger our take profit level. What did it start doing? It started giving us what? Lower high, lower low, 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 lower high. Then triggered our point of entry. This is what? Trend line liquidity. Remember, I said it's more convincing for me to take a trade that the market approaches the POI in a trend-like manner because it tells me that there's money in the market there. So since this is trend line liquidity, my take profit level will be at where the trend originated from, which should be up here. This will be my nearest draw on liquidity for this market. Now, I would not think of opposing the market direction with this other block, God forbid, this breaker block, God forbid also, this other block. So this is why people do, they'll keep getting stopped out because they are picking trades from any POI they have here. Not knowing that the POIs that they are marking are all enclosed inside of a liquidity zone. So this is what I'll taught you guys. This is a structure shift inducement point of interest. But at this level, you're skeptical with where your take profit level would be because you're very confused. Now, if you check before price now, like I said, there are two ways to use trend line liquidity. First way is when market was on a particular trend for an extensive period of time, then shift structure gives you inducement and your point of interest, then you target where the trend originated from. Then the most common way, the second way is what? When market gives you a structure shift inducement and your point of interest. Then during the process of coming to approach that point of interest, it now starts giving you a trend-like pattern. That trend-like pattern will be where you target for your take profit level. So that is it here. So no matter any pair, every pair that you pick, majority of them approaches a point of interest in a trend-like manner. This sell, trend line. This buy, trend line. So all the trades that we took, no matter the pair, you must always see trend line liquidity there. It's one of the most common types of liquidity that you have in the market. And you can literally use it to take your profits no matter what pair you are trading. So that is it on trend line liquidity. Hope you guys understood trend line liquidity, right? Mm-hmm. So I had to use different pairs to show you. So you see, showed you with gold, showed you with BTC, showed you with JPY. So literally everywhere. This is one of the most common types of liquidity that we have in the market. Now, after trendline liquidity, then we have equal highs and equal lows liquidity, which is not really that rampant on the chart. To be honest, the last time I saw equal highs liquidity in the market was in 2023, I think. 2023. That was the last time, and I can't really see an example of it on this chart, but I will see it anyway, just in case you see it on the chart. But I can't remember the last time that I've seen it or used it on the chart. But it's one type of liquidity that we have in the market. Now, that is equal highs and equal lows liquidity. Most people call it double top and double bottom. Now, when people think of the concept of that is when market gives you a relative equal high or a relative equal low, that is price coming up to give you a high, then making another high equal, completely equal to the last one he made. Most people see this as a reversal pattern. And the moment that price gives you this, price about to reverse to the downside. No. Whenever market does something like this, it means that there's liquidity being accumulated on that upside that price gave you that equal high or double top, which is here. This is equal highs liquidity. The market gives you a relative low that is coming here, making a low, then making another low, completely equal to the last one. That is equal lows liquidity. So it's equal high, sorry. Equal high liquidity. Then this is equal lows liquidity. Now, what does this mean? It means that whenever I can't give you guys example on the chart with this because to be honest, I don't know. I've not seen this on the chart since 2023 last. So I can't really give an example of it on the chart because it has not actually appeared on the chart since then. But it's basically your market makes a high, then makes an equal, like it's going to be on the same line. It's going to be equal on the same line. That's what you call equal highs and equal lows liquidity. When that happens, it means there's liquidity on that equal low or there's liquidity on that equal high. And how you can use it in taking your profit is when market gives you an equal high or an equal low while coming to trigger your point of interest. For example, let's say you have a POI here for a sell. Now, before price triggered that point of interest for the sell, it made this equal lows here. Then eventually starts coming to trigger the point of interest for the sell. The moment that point of interest gets triggered, you have to observe the pattern that price was previously on. Now, there are two ways you can even take your profit here. Either you incorporate trendline liquidity or you incorporate that equal lows liquidity. Regardless, market will still end up at the bottom of this low. Meaning that if you take a sell from this other block level or the POI that you have marked out for the sell, your take profit level for the trade would be this equal low because it's a type of liquidity. And remember, wherever there's liquidity in the market, price will always head to where there's liquidity to sweep that liquidity zone. So if market was about to trigger a sell POI, then before that, market gives you an equal lows liquidity. It means that the nearest draw on liquidity where price is heading to will be to clear that equal low. So any point of interest that you may have that can reverse the market direction to the upside from this sell, do not try and take that if it's inside of this equal low. For example, if the point of interest is here, or maybe like this breaker, or like an other block here, don't try to use that point of interest and start looking for buys because market will keep taking you out until it successfully clears this equal low. That is one type of liquidity again that will have equal lows and equal highs liquidity. Not that common, but it's still nice to know. So I can't give you guys an example on the chart because I can't really see it on the chart. I've not used it since 20. I saw it last on gold in 2023 or 2024 May. Yeah, I think I've forgotten the particular trade, but that was when I used it last. Same thing as the equal high liquidity. Let's assume that you have a POI here that you're meant to take a buy from. Then before price approached that point of interest for the buy, it gave you an equal high. It has to be on the same line, a relative equal high liquidity. After that, price will now come and trigger your point of interest for the buy. The moment that happens, all you have to do is to observe the pattern that price was making before your point of interest for the buy got triggered. And if you observe the pattern, you can clearly spot an equal high liquidity up here. It means that if you start taking a buy from this PI that you have marked out, your TP level will be to aim at where the equal highest liquidity is, meaning that any point of interest that you may have to oppose the market direction for maybe to start selling the market, you don't pay attention to it until price successfully takes out the nearest draw on liquidity. So what I'm telling you guys is wherever you spot a liquidity pattern, don't try to oppose that liquidity zone until let me see, whenever you spot a liquidity pattern, let's say downtrend. A downtrend has liquidity at the upside, an uptrend has liquidity at the downside. Whenever market is already at the process of reversing, you have a point of interest triggered. I already have that liquidity zone marked out. You already know the type of liquidity that you have, so you know how to take your profit using that type of liquidity. Don't try to oppose the market direction when market has not yet successfully cleared that liquidity pattern that you previously marked out. If it's correct, this is trendline liquidity here. Now, if market is about to clear this trendline liquidity, don't try to start buying with the other block here simply because there's an order block there. Don't try to buy with any POI that are inside of this zone when market is already at the process of what? Clearing the liquidity zone. So that is one mistake that most people make. They ignore the liquidity patterns and then they focus on the POIs that they have there, ignoring the liquidity zones in the market. You don't do that. Market will always go and try and clear liquidity zones. So when market is at the process of clearing those liquidity zones, do not oppose the market direction when they are at the process of clearing those liquidity zones there in the market. So I've already given you guys one example, which is what trendline liquidity, the uptrend and the downtrend. The second example, which is the equal highs and equal lows liquidity. Then the last example, hmm, sorry, I want to still see if I can spot this thing. Okay, see another trade here. S- Structure shifts, inducement, POI, this breaker block. This is GBP USD. This is inducement. So you have the trade marked out. Good. Now, where would you now keep your take profit level? You're confused on your take profit level. Good and fine. I remember, when Iyke was teaching us types of liquidity, he said there's trend line liquidity. Oh. And then when there's trend line liquidity, price will head to where the trend started from. So if you check, you can clearly see a clear uptrend here. So because of that, if I should take my sell from this GBP USD breaker block, this is it, structure shift when this low was taken out, inducement, the pullback, and then the nearest POI is the breaker block. Okay. My take profit level will be aimed at what? This trend line liquidity getting swept. So, like I said, it's always on the chart. All you have to do is what? Find it. Always at the chart. All you have to do is find it. See? Other block here. Structure shift, inducement, POI here. Before the point of interest got approached, what the market start doing? Higher high, higher low, 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 higher. So another example of what? Trend line liquidity. So the moment that happens, take profit level. When Ike was teaching us, he mentioned trend line liquidity. So because of that, I will not lose my account today because Ike taught me well. Bam, trend line liquidity. So any point of interest that you have inside of trendline liquidity, don't try and use it and oppose the market direction until it successfully clears that liquidity zone. Do you understand? So same thing here, trendline liquidity. This is the first example I gave. Where market on a particular trend, then it's now changing direction, giving you see this low was taken out, sort of shift, inducement, and then this breaker here got triggered. So our take profit level, what? The pattern that price was previously on before the structure shift happened. Trendline liquidity. See? So it's very simple. It's not even stressful at all. All you have to do is to observe the pattern that price was previously on before your point of interest got triggered or before the shift in structure happened. Same thing here, previous uptrend. Then all of a sudden price took down the low, gave inducement, then triggered our nearest POI, breaker block. Okay, I'm now confused. Oh, my take profit level will be, oh no, I'm so confused. Bam, trendline liquidity. See where the trend originated from. And it increases your RR 1 is to 10, 1 is to 13, 1 is to 19, 1 is to 16. So you see how it increases your RR simply by knowing where market is going to. Now, most people that don't have sense would have hit multiple stop losses. First of all, from buying at this level. Second of all, buying from this level. Thirdly, buying from this OB. Fourthly, they will buy from here also. I know you. You're looking at me. You know I'm talking to you. You know what you can do. Another loss from here. Another loss from here also. And the thing is that when they hit the loss, they will move to the next point of interest. Another loss here also. Once they hit the loss, what they will do is to move to another point of interest. It's not like they're going to even leave the market. They will go to the other point of interest. They don't want to observe the market and see whether they are wrong or not in the direction of the market. So that is one way of taking your profits in the market using trend line liquidity. I hope you guys are following me. I'm not be joke at the crack before people go they laugh for you. No, 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 I know they crack joke. I don't know why you guys are taking. I'm not cracking jokes. Just I- so that is one of the most. See how many pairs I've checked now: GBP USD, GBP JPY, gold, BTC USD. Every is across every single pair. Trendline liquidity is one of the most common type of liquidity that you can have in the market. Do you understand? I've used 1 hour to talk about trendline liquidity. This is 10 o'clock already, but so let me just move on to the other type of liquidity that we have in the market, which is ranging liquidity. Now, ranging liquidity. Now, just because remember, you still have to know if it is something, and I'm showing it on the chart, it looks so easy, but it's not really that easy if you don't have patience and if you're not calm to actually spot these things on the chart. Simply because you are taught something doesn't mean you should rush the market. You should not be rushing to make profit. In fact, it's even better you analyze the chart around 10 p.m. like this because market is mostly closed and it's not really moving that fast. So when market is already closed around 10 p.m., like spread hour, market is going to be calm and you can actually look at the chart and analyze it to be able to spot all these kind of things because market will be stagnant. While you're rushing to make an entry, pick an entry, make money, you're going to get so confused because everything is literally going to be on your face and you will not really have time to properly analyze. But once market is paused like this, you can actually go through and observe certain things in the market. So this is I've already talked about two types of liquidity that we have in the market and how we can take our profits. Talked about trendline liquidity, which is the uptrend and the downtrend. And I also talked about the equal highs and equal lows liquidity, which is the double top and the double bottom. Second, now the third one is what we call ranging liquidity. Ranging liquidity. Okay, here I use. Okay. So the third one is called ranging liquidity. Um, is it NTD card or NTD CSF? Forgetting the pay. Okay. Now, there are pairs that do not actually move a lot. There are pairs that are very slow, like extremely slow pairs. NC, NZD, CHF, NZD card, DBPC, all these pairs, they are very sluggish in movement. So because of that, they tend to range a lot. So most of these pairs, I take my profit using these pairs using ranging. In fact, I don't even trade these pairs, God forbid. But I'm just giving you guys an example. There are people that love it. Do you understand? So mostly you can apply other concepts of liquidity to take your profit, but mostly because it ranges a lot, market is mostly using ranging liquidity in this kind of pairs. So ranging liquidity is when market is consolidating or ranging between two sides on the market, which is what the sell side liquidity and then the buy side liquidity. Knowledge full this my head, but no worry, I just talk. Now, sell side liquidity, buy side liquidity is whenever is the types of liquidity that market gives us when price is ranging. So for example, a range is basically your market is moving from two sides of the chart from basically your support level, it will go to your resistance level, it will come to the support level to the resistance level to the support level to resistance level. So this is what a range is. Basically market consolidating at two sides. So the one on the upside is called buy side liquidity. The one on the downside is called sell side liquidity. Now, how do you apply these concepts in your take profit level? Simple. Market is fueled by liquidity. Whenever liquidity is being taken out from one side of the chart, price will want to go and take out liquidity on the other side of the chart. So that is where the concept of ranging liquidity comes in. Now, first of all, before you can have ranging liquidity, you must already have the direction of the market in mind. You must already have your inducement and you must already have your POI in mind also. So for example, let's assume that price gives us a structure shift, gives us inducement, then starts ranging. Now, my market is doing this. The liquidity being accumulated on the downside here is called the sell side liquidity. Then the one on the upside here is called the buy side liquidity. This movement is called a range. This is buy side liquidity. This is sell side liquidity. So what market is going to do is that it's going to keep ranging until it takes out liquidity on the side, on the opposite side where it's meant to go to. For example, you have a POI down here, other block for the buy. Now, since market is ranging and market is bullish, what it's going to do is that it's going to go and take out liquidity on downside first. So it's going to keep ranging till eventually it will take out liquidity on this sell side, then trigger your point of interest for the buy. Once this happens, you know that where market is going to next is to go and take out the liquidity on the buy side, which means it will buy until price takes out this range on the other side. So that's how you can take your profits when market is ranging. You already have your parameters marked out. You already have the buy side liquidity and the sell side liquidity marked out. Then you wait for market to take out liquidity on the opposite side where it's meant to go to. So if it's meant to go to the upside, price will take out liquidity on the downside first and trigger the point of interest. Once that happens, the take profit level will be aimed at the other side of the range, which will be here. Then same thing, if market is bearish, get the structure shifts, then market gets inducement and price will start ranging. Now, this is what buy side liquidity on the upside, sell side liquidity on the downside. And our point of interest will be the other block here. So market is going to keep ranging until it takes out liquidity on the opposite side the market is meant to go to. So market is meant to be to sell. So it's going to take out liquidity on the opposite side first, which is what on the upside. So market is going to range till eventually it takes out this high and trigger your point of interest. And where it's going to go to next is the other side of the range, which will be down here. So pairs that range a lot, like this pair, NZD card, you can see it here. So just shifts. In this moment, then price started ranging. So here, buy side liquidity. Down here, sell side liquidity. So the point of interest, since the market is bearish, the point of interest is this 4 hours other block here. So market is going to keep ranging. This is the buy side. Down here is the sell side. Until eventually it's going to sweep liquidity on the opposite side of the direction that market is meant to go to. So the market is meant to sell. It will sweep the liquidity on the upside first, then trigger the point of interest for the sell. Once that happens, the take profit level will be end at the other side of the range, which will be down here for this sell side liquidity. Now, notice what market did. If I didn't understand the concept of what of ranging liquidity, I wouldn't have known where to keep my take profit. So let's assume I extended this take profit level here. What the price do? Eventually, it took out the other side of the range and it bought. And then if I was still on this trade, it would have hit my what? My stop loss. Simply because I couldn't understand where to keep my take profit level when it comes to dealing with ranging liquidity. So this is a I don't trade this pair. God forbid that we have to wait how many days. This POI formed on the 24th of April. It triggered on the 2nd of June, God forbid, 12 and Yojo. So this is for people that like weird people now, people that are not normal, that like trading pairs like this. So you can apply ranging liquidity in all these kind of pairs that are very, very sluggish and very slow. But us normal people, we trade gold, BTC USD, GP JPY, GP USD, Euro USD, all those normal pairs compared to this kind of pairs that abnormal human beings trade. So but you can also apply other types of liquidity here also. If you pay attention, you can actually see price giving us a structural shift, inducement. The inducement triggered the breaker. The nearest point of interest is now the other block up here. And before price triggered this other block, it was what? It started giving us this uptrend. So this is what? An uptrend line liquidity. So if I should take my sell from that OB, my take profit level for this trade will be aimed at what? Where the trend originated from down here. So you see, literally, trendline liquidity can be applied across every pair. This is another pair now, SAD card. In as much as I used ranging liquidity, I still was able to apply the concept of uh of trendline liquidity here. So even with hang on, I'm talking about, I still want to talk about another way you can take your people are already asking me about continuation patterns. Yeah, it's still you can apply those concepts there, but continuation patterns majorly there's this final way we can also take our profit in the market, which is by using the last swing high or the last swing low in the market before our point of interest gets triggered. What do I mean by that? Let's assume we have this high and price is giving us higher highs, higher lows, higher highs, higher lows, and gives us a double structure shift. Sorry, a double break of structure, taking this high and then this high. After that, gives us our inducement, then pushes up. Nearest POI here is this breaker block. The moment price comes to trigger this breaker block, the last swing high in the market before the point of interest gets triggered will be here. So if it's for continuation patterns, once this pattern here gets triggered, you can use this last swing high here as your take profit level. So this is actually another way of using the nearest joint liquidity. So not only can you use it in continuation patterns, you can also use it in reversal patterns. For example, this is what this downtrend line liquidity, but at the same time, this is the last swing low in the market before our point of interest got triggered. And you can use that last swing low as your take profit level also, or you can also incorporate trend line liquidity there. You can also incorporate it here. This was the last swing low that price made before price came to trigger our point of interest. So that last swing low can also be our take profits in the market. You can apply it everywhere. So you can apply it everywhere. So if you don't see trend line liquidity, if you don't see equal highs and equal lows liquidity, if you don't see ranging liquidity, you can also apply the last high or the last swing low in the market before your point of interest got triggered. So if you have a point of interest, before price comes to trigger that point of interest, the last high or the last low in the market before that point of interest got triggered can also be used as your take profit level and can also be used as the last swing high or the last swing low. This is the last swing high. This is a continuation entry. When market started buying, what did it do? It bought until it went and cleared that last swing high in the market before the point of interest got triggered. This is the last swing high. When that price bought from this OB, it bought until it cleared that last swing high. You understand? This is the last swing high before the point of interest here got triggered. So if you're buying, you can buy until price clears that last swing high also. Remember, with experience, because I'm not going to say that you're going to learn everything or be able to master and hold trades for as long as I do right now, because even in as much as I can see trendline liquidity, I can take my profit from trendline liquidity, but based off of experience, I can still know that price is meant to go higher. But when we talk about directional bias, you understand what I mean. So I can still intend to hold my trades longer than that, simply because I understand the concept that market is meant to surge higher or go here on the daily time frame. So, but I'm talking about the nearest draw on liquidity, the zones that is nearest for you to take your profit in the market. So you can apply that concept of the last swing high and the last swing low. This is the last swing high in the market. Before price came down to trigger was this other block here. When price triggered the other block, if you took your trade, your buy from here, you cannot see trend line liquidity here, but you can still see the last swing high. So you can keep your take profit level at that last swing high. So if you're trading continuation patterns, you can use the last swing high or the last swing low in the market before your point of interest got triggered. Do you understand? So it works with trendline liquidity itself. This is trendline liquidity, yeah. But at the same time, it is literally the last swing low in the market before our point of interest got triggered. So you can use it as your take profit level. You can apply it everywhere. It's the nearest drawn liquidity. So with all these things, I thought you also see this was a high, but it was not the last high that was made before price came to our point of interest. No, the last high that was made was this one before price came to trigger our point of interest. So this high is also our take profit level. So either we apply the concept of trendline liquidity there, or can also apply the concept of the last swing high before our point of interest here got triggered. So that is how you can take your profit in the market. This here was not the last high that was made for price to trigger our point of interest. No, price went high and made another high before our point of interest got triggered. So when the point of interest got triggered, we can use that high as the last swing high in the market before our point of interest got triggered. So either we apply the concept of trendline liquidity, or we can also apply the concept of the last swing high before our point of interest got triggered. So with these things I taught you guys, I hope I was able to convince and not confuse you guys to take your trading seriously. These are the ways that I don't use any confirmation before taking a trade. So these are the ways you can take your profit in the market. It's already been an hour, 15 minutes. So remember I said the questions for this class, because this topic is a complex topic that you have to sit down and back test before you are able to get these kind of things. So once the recording of this class is done, I'll send it to the group. Then if you watch the recording and you have questions, have your questions written down. Our next class is the directional bias class. Once we have that, there will be a question session for all the questions that you have. This is how we do it. So each topic we have, you send the recording, then the next class you ask the questions. That was how we did the first one. The first class, there was no top questions. Second class, I accepted all the questions. Third class is this, no questions. You have the questions written down after the recording. Then the fourth class, you bring up all those questions with with the questions for that class also. So it's already an past 1 hour. But the next class will be about directional bias. So you actually know when to trade the market in the right direction. So it will also help you a lot, because most people also make mistakes of, yes, you have your structure sheets, you have your inducement, or you have your break of structure inducement, and you have your point of interest, but you're trading in the wrong direction of the market and you end up getting stopped out. So backtest this topic well, forward test it also, go to the chart and find out that price also uses these patterns as take profit level. In fact, I went to different charts. I went to NZD card, I went to gold, I went to GBP USD, I went to BTC USD, I went to GBP, 5 different pairs, and everything I thought was there across all the pairs. So just have to we just have to have patience to wait for these things to form on their own. Without patience, you can't really do anything in trading. So uh I don't use forex.com as a broker. I use forex.com on my charts if I want to look at this thing to analyze. I don't use forex.com as a broker. Someone asked me about forex.com. So our next class is on Sunday, yeah? So by then you must have watched this recording, and any questions you will have, just bring it to me. Do you understand? And we'll talk about directional bias in that class. Everything is going to get pieced up together for you guys. I hope you guys enjoyed the class.